What's up, everybody? So I'm coming back to you with another video speaking about the basics of investing. So I had some comments that were given to me by email and in some of the videos below that I recently produced, and people were asking questions. Can you just break down the basics of investing for us? So that's exactly what we're going to do in this video. Today we're going to be talking about investing in fixed income bonds. Hello everybody, my name is Paul Zachary Shelton Jr. and I'm the Chief Investment Officer of Warwick Shore Advisors. We are an investment management and wealth management firm located in Orlando, Florida with clients all across the United States. If this is your first time viewing one of my videos, I ask that you please hit the subscribe button. Please ring the bell so that you can get an update each time I publish a new video. Also, please like and share this video. It helps me share and grow the financial literacy of our globe. Before I get into today's topic, I want to ask, and I want to actually offer, not ask, but offer you the chance to get a free financial planning cheat sheet. It is like a scaled down version of the financial plans that I typically provide for all my clients, but it will give you a good viewpoint of where you are right now in your finances, and it'll give you a stance of where you can start your financial plan on and moving forward to eliminate debt or anything like that that you have, or reaching any financial goals that you may have. I will also throw in a asset allocation that you can use during turbulent and very volatile markets like we have seen recently. So if you're interested in that, please send me an email at investments@warwickshore.com. Leave a comment below and I'll also reply to that and send it over to you as well. So today we're going to be talking about investing in bonds. What bonds are, or what are bonds, and what classification do they fall under? How do you make money off bonds? All things bonds. So you hear a lot of people often talk about fixed income investing. So bonds fall into the category of fixed income investing, and very similar to stocks, companies will issue bonds to raise capital. And they'll either issue, like I mentioned before in one of the videos, do an IPO, which is the initial public offering, where they issue new stocks. They'll also can issue new bonds, and it all depends upon how the company wants to position itself with the amount of equity and amount of debt that it has on its balance sheet. That's for another video. We're not going to talk about that today. But a company will issue bonds, and when they issue bonds, the company is considered the borrower in that transaction. And us, the investors, those who buy the bonds, are considered the lender. We are lending the company our money so they can use it internally to do whatever they need to do. Change light bulbs, or buy new doors. No, not exactly. So typically companies use that money to take care of some of the tangible things that are taking place in a business, such as equipment, or research and development, anything like that that may take place, that there would be a large cash need for. They'll go to the market and say, hey, we need $1 billion and we need this fairly quickly, or quickly enough in a good amount of time. So we're not going to issue stock for it, but we're just going to go out there and issue bonds, because we know the bond market will respond a little bit quicker than underwriting the IPO and issuing stocks. So they'll go out and say, we're going to issue $1 billion worth of bonds. And since we're a company that is very good and we have a good credit rating, we can issue these bonds at a lower interest rate. So therefore, if they have $1 billion of bonds and they're going to lend them out to the investors, and the investors are going to go out there and buy those, there's going to be two things that the investors are going to receive. They're going to receive interest payments on that money that they lend to the company. And that interest payments are going to be the interest rate that the company has to pay us, as far as like the coupon, the regular semi-annual payments that we would receive for holding those bonds. So the two ways that you can get paid for investing in bonds is through the principal repayment that you're going to receive back at the end, and by holding the bonds and receiving the coupon payments on it, which is really just the interest that the company says they're going to pay us for borrowing our money to lend it. Now, there are certain ways that the interest rate or that coupon rate is determined when a company is going to issue bonds, and it all depends upon its credit rating. So the better the credit rating of that company, just like with individuals, the better your credit is, the lower the rate you'll have to pay. The worse the credit is, the higher the interest rate you'll have to pay. There's a few companies out there that issue credit ratings for companies, and that's the S&P, Standard & Poor's, Fitch, and Moody's. So they all issue credit ratings for every company and for municipalities as well. And they rate those companies and cities and states and municipalities based on their credit worthiness. So if you're looking to invest in different bonds, a lot of times you'll see people hear people talk about, oh, this is an investment grade bond, or this may be a AAA bond, or this may be a junk bond or a high yield bond. And you're kind of confused and like, what do all those terms mean? I thought bonds were just bonds. Why are some of them junky and some of them have a high yield? All this different stuff. That really all just boils down to the credit rating of it. Most investment grade bonds are really AAA in that range bonds. All the credit rating agencies do have slightly different scales in how they grade them, but the criteria is primarily the same. The high yield bonds are typically the bonds that have a high yield. They're upwards of maybe 6-8%, even higher. It really depends on where interest rates are in the country and how that's determined as high. Yielding bonds, a lot of times those high yielding bonds, the interest rate is high or the yield is high on them because they are a little bit more riskier. So again, it's a sort of subset of supply and demand. It's general economics. If you have a good credit report, good credit rating, you're going to pay a lower interest rate. If a company has a good credit rating, they can offer their bonds out at a lower credit or interest rate, essentially a lower coupon, than a company that may be very risky or a company that is unknown. They may have to offer out their bonds at a much higher interest rate or a much higher coupon rate in order to get the interest from the investors to invest in their bonds. So last thing I want to mention is that the bonds are typically broken down into two different sides, two different segments, and I kind of alluded to it before. You have muni bonds, which are municipal bonds, which are backed by cities, local governments, and things of that nature, oftentimes states, the federal government, U.S. And then you also have corporate bonds, which are bonds that are just what they sound like, corporate bonds for U.S. corporations, or it could be international corporations as well. So those are pretty much, that's pretty much the gist of investing in bonds and the good know-how of investing in bonds. I'm going to provide a breakdown in a future video on what it looks like to invest in bonds, how to calculate the payment, your coupon payment, and what to expect when you're receiving your return, or what kind of return to expect in your bonds when you're receiving a bond. If this is your first time viewing one of my videos or visiting my channel, I ask that you please hit the subscribe button. Please like this video, please share this video. It is my goal to increase the financial literacy of this globe. Thank you so much for tuning in and have a great day.